And the reason that there is a chance for this is that I don't think either side understands that even a temporary breach of the debt ceiling could cause the collapse of the entire pyramid. Well, hello there, my friends. Rafi from the Endgame Investor with this week's Silver Report for Arcadia Economics. There's a lot to talk about today. There's some crazy shenanigans going on with the debt ceiling that is causing all kinds of havoc in the short-term Treasury market, havoc that we have not seen since August 2007 when the subprime mortgage crisis became a global crisis when they thought it would be contained, and they discovered that in August 2007, it was not contained, and the spread on 1 month to 3 month treasuries reached an all-time record that was only just broken a few days ago because of the debt ceiling debacle. We're going to look into individual vaults in the COMEX. We're going to look at Loomis, which has lost 6.5 million ounces over the last 6 weeks. We're going to look at JP Morgan, which is down to about 20 million ounces that it can possibly sell if it wants to pad the silver supply. The registered supply has hit another post-silver squeeze low, and the money supply, the dollar supply in the banking system, is now deflating at a rate of over 5.3% annual. We have never been here before, and the monetary debt pyramid cannot withstand this pressure for much longer. We have more regional banks failing. First Republic looks like it's on the verge of dying. What is most impressive, really, about this current deflation in the money supply is that it is happening at a seasonal peak, what is usually a seasonal peak in the money supply, and it keeps falling, and it's going to fall even more next month as it will account for tax day, which vacuums money out of the banking system and into the Treasury's account at the Fed. So on with this week's Silver Report. This week's Silver Report is brought to you by Fortuna Silver Mines, symbol FSM. And though there is no new news out, there is a new investor presentation, and we'll take a look at this page of it. For April 2023, annual guidance is up between 3 and 15% over 2022, and we have the all-in sustaining costs for each of its major gold and silver mines. Lindero at between $1,430 and $1,580 an ounce. Yaramoko between $1,550 and $1,710 an ounce. Seguela, very impressive, $880 to $1,080 an ounce. That is a profit margin of about 100%, close to it. San Jose mine, silver mine of $14.7 to $16.2, and Kaloma mine of $19 to $21, all comfortably profitable. And the Seguela gold mine, which is the lowest all-in sustaining cost of its projects, that is scheduled for its first gold pour in May 2023, which is in a few days. The first thing I want to show you here is of a technical nature that could show us some short-term clues. Silver open interest is finally starting to fall. We're down to about 144,000. This is a day behind. It says 149,000 here, but we fell, I think, another 5,000 or so contracts. We're about 144, 145,000. I'd like to see us get down to about 120,000 open contracts. That would create a lot of space for another good move. But even if it doesn't fall that far, the fact that open interest is finally starting to fall means that we're at the end of this corrective move, and that's a good sign. We have deliveries starting tomorrow or today, if you're listening to this today, which you are because it's Friday for you. And after these deliveries are done, we should see the pressure let up on the silver market. I want to point out a few things that are happening in the vaults that are a little bit out of the ordinary and exciting and interesting. First, we have the Delaware Depository, which specializes in individual retirement accounts or storing precious metals for IRAs. We've seen, you can see here a little bit on the edge of this chart. I can't zoom in on this, so I'm sorry about that. A spike of looks to be about 1.5 to 2 million ounces in the last few weeks. Last week, actually, I think we're up to 42.465 million ounces, an all-time record high for silver storage. This is not silver for sale on the futures market. This is eligible stocks, and it's been going up pretty vertically since the beginning of 2022. JP Morgan is almost out of silver, down to maybe about 20 million ounces. Why? Because it says here we have 140.78 million ounces in total. 10 million, about 10 million is registered already for sale. So the extra silver that they have would be the 130.8 million minus the 103 million that are part of SLV. So that brings us down to about 27.6 million. You take, let's say, conservative 7 to 8 million ounces of that are privately owned in the JP Morgan vault. It's about 20 million ounces. That's not a lot. You see here that they put about 35 million ounces for sale in July. They do not have that much anymore, and so they can't pad the silver market with that much physical supply anymore, not this time. We're also at a new post-silver squeeze low in the registered supply of 30.54 million ounces. We'll see if that goes down after tomorrow's deliveries begin. I wanted to point this out about the money supply. This is the quarterly annualized money supply growth rate going back to 2006. I had to put this bar all the way below the graph, which is a new thing for me. I just changed it so we can see the negative numbers more clearly here. This is the recent plunge from negative about 2% to now we're at negative 5.3%. This is absolute deflation. We've been in absolute deflation since the turn of 2022. We've been in deflation for like, wow, 5 quarters already. That is unprecedented, completely unprecedented. And there's going to be some reckoning, some payment for this very soon. I don't see how the pyramid can survive this for much longer. And the reason that this deflation is so spectacular is that if you look at this is the absolute M2 money supply going back to 2021. And I could show you back all the way from, to the period of 2015 to 2020, before the lockdown started, that the weeks of March to the first week of April is generally a very strong time seasonally for money supply growth. We see here in 2021, the money supply grew from about 19.6 trillion to 20.4 trillion, something around there. And also in those 3 weeks in 2022, we still saw a growing money supply here. And the peak usually happens at around tax day, which is around here between the first and third weeks of April. But here, when it stops, we see a big drop around tax day. And here, which is supposed to be a peak in money supply growth seasonally, we see it's just another trough now, which is going to mean we're going to see a huge fall in money supply in the next month's numbers, which is really this month because we're on a 4-week delay. We're going to be at intense deflation, maybe 7-8% annual by next month, which is now. For those tracking the Strategic Petroleum Reserve, the oil drain has restarted. It's restarted at the end of March this year, where we had 371,579,000 barrels, and now we are down to 366,942,000. Here's what the government says about the SPR. This is from Bloomberg. The article says, U.S. could begin to refill the Strategic Petroleum Reserve in fall. Envoy says, remember that they said the same thing in February. They're going to restart refilling it in February. They never did. They didn't get the right price. So here's what Bloomberg says. The U.S. could begin to refill its Strategic Petroleum Reserve as soon at the third quarter of 2023, if the price is right. The U.S. official responsible for energy diplomacy said, if the price is right, yes.
Come on down! You're the next contestant on The Price is Right!
I think as we get into the early fall, if prices are in the right place, we are still 100% committed to replenishing the SPR over a period of time, says Amos Hochstein, the Special Presidential Coordinator for Global Infrastructure and Energy Security. So if the prices are right, he's 100% committed.
60% of the time, it works every time.
That doesn't make sense.
Now, I wanted to talk about the debt ceiling because it seems that short-term treasury markets are taking it seriously as a real chance that the debt ceiling could be temporarily breached. And the reason that there is a chance for this is that I don't think either side understands that even a temporary breach of the debt ceiling could cause the collapse of the entire pyramid. Nobody knows exactly what will happen on a temporary default, but the fact that nobody seems to think that it could cause the collapse of the entire pyramid makes a lot more likely that that is what could actually happen.
So what'll happen? That's just it. We don't know. Maybe something bad. Maybe something good.
I'll show you what's happening now in the short-term treasury markets, what it has to do with the debt ceiling, and what happened back in August 2007. This is a chart of the spread between 3-month and 1-month treasuries in August 2007. 2007 to 2009, this is a chart. So we see here 1.71 was a high on August 13th, 2007. That was the highest that the spread ever got. That means that people were selling off 3-month treasuries and buying 1-month treasuries. Why were they doing that? Because the commercial paper market was falling apart at the time and people were worried about everything but the shortest term paper. If we go to what's happening now, this is a high of 1.85, a trade between 3-month and 1-month paper. It has never, ever been this high before. The only other time was August 2007. That didn't even reach this high. That was 1.71. So what exactly was going on in August 2007? August 9th, 2007, the day the mortgage crisis went global. These two paragraphs could have been written yesterday. August 9th, 2007 marked the beginning of the most far-reaching economic disruption since World War II. The events that Thursday made clear that subprime lending excesses wouldn't be contained. Inflation wouldn't be transitory, as Ben Bernanke, the Federal Reserve chairman, had predicted just months earlier. Yet few people appreciated the scope of the disaster that would unfold over the next 18 months. By now, it is widely understood, widely understood, that the global financial industry was over-leveraged, that investors and financial institutions everywhere were paying high prices for highly rated securities that were actually extremely risky. How do I know that even a temporary debt ceiling default could knock over the entire financial pyramid? Well, check out this article from Reuters. Speed of U.S. bank failures to play starring role in Fed FDIC post-mortems. What does that mean? It basically means they don't understand how everything happened so fast with the collapse of Silicon Valley Bank. Of all the facts, it starts, that have emerged about last month's 2 U.S. bank busts, the unanswered warning letters from regulators, the ignored interest rate risk, the outsized levels of uninsured deposits, one data point in particular continues to stir deep-seated unease among finance officials. 36. That's roughly the number of hours it took Silicon Valley Bank to go from a functioning regional lender to being seized by regulators after the fastest bank run in U.S. history saw $42 billion of deposits yanked in 24 hours. Here we have a quote from Rafael Bostic, head of the Atlanta Fed. The number 36 has just been, branded in my brain. Atlanta Fed President Rafael Bostic told Reuters earlier this month, how should we be thinking about relationships given that speed? And how do we think about protocols given that speed?
I saw this in a movie about a bus that had to speed around the city, keeping its speed over 50. And if its speed dropped, it would explode. I think it was called The Bus That Couldn't Slow Down.
The answer is you don't have time to think about relationships given that speed. You don't have time for protocols given that speed. A temporary debt ceiling default could destabilize the entire pyramid because the Treasury yields are a benchmark to the entire global financial system. And if you default on any amount of that, it could cause a global panic in less than 36 hours, just like you saw in Silicon Valley Bank. Do I know this for certain? No, but I do know for certain that everything is extremely unstable and a tiny little knock could spread throughout the world like the butterfly effect. You don't want to mess with it, but it's going to happen anyway. So this is showing that the market is taking very seriously the probability of a temporary debt default. And because nobody in Congress can even consider the possibility that a temporary default would collapse the entire financial pyramid, they might take it seriously as a bargaining chip to cause a default for a few days, see what happens, and then cause the other team to get close to their negotiating position or whatever the stupid brinkmanship is. But there's another small thing that could happen with a temporary default because of, again, money market funds. Well, we have this article, House Republicans pass debt ceiling bill in victory for Speaker Kevin McCarthy. And what are the Democrats thinking of Kevin McCarthy at this point? As the so-called Limit, Save, Grow Act also included a laundry list of Republican policy priorities, including rolling back initiatives from Joe Biden's administration, such as the cancellation of student loan debt. Now, what does it have to do with money market funds? Well, if there is a temporary default on the debt ceiling, then what happens to all the money market funds that are invested in short-term treasuries, some of which could get defaulted on? Well, we have the answer to that question here. Money market funds, flush with deposits after investors sought safety during last month's banking turmoil, are now confronted by the political standoff over the U.S. debt ceiling that threatens to disrupt their investment portfolios. While the U.S. is not expected to default on its obligations, a prolonged standoff in Washington over raising the federal borrowing limit could create difficulties with buying and selling the short-term debt, potentially leading to some losses for money funds, money market funds. The alternative to buying treasury bills, stashing cash overnight with the Fed, could add to strains in the banking system. So what does that mean? That means that it becomes more secure in that time if there's a debt ceiling default to suck out more money from the banking system and put it in reverse repos that the Fed pays, because the Fed has no debt ceiling. So if you're going to suck even more money out of the banking system, you're going to create even more intense deflation, and you're going to very quickly collapse the entire financial pyramid, which is built on nothing more than confidence. Both sides are full of hubris and ignorance, a great combination for collapsing the world's most gargantuan financial pyramid ever constructed. This is Rafi, the Endgame Investor. If you enjoyed this Silver Report, then sign up for a 2-week free trial of the Endgame Investor or become my patron on Patreon, where you will get a once weekly biblical commentary on things that are going on now. How am I going to spin the debt ceiling into these topics? I'm not sure yet, but I'm working on it. And I'll see you guys next week.